Hello, everyone. I'm Larry Roth, CEO of Wealth Solutions Report. Thank you all for taking time to join us today. We're excited about this discussion with Bob, and I'm looking forward to seeing or hearing any feedback you might have. Everyone on this call is aware that there's been some really exciting developments in private markets over the last several years, and during that period of time, Bob Long, CEO of StepStone Group's wealth management business has launched and grown them to a tremendous way, and we're quite excited to have you, Bob, today. So thank you for being here.
My pleasure.
Before we begin, I would like to cover just a couple of items that I think that'll make this more interesting and fun for everybody who's involved. If you take a look to the right of your screen, there are a couple of little icons. One of them is a bar chart. That is where we're going to be taking a few polls. So in 3 or 4 instances today, we'll launch a poll. We'd ask you if you wouldn't mind just to reach over there and respond as however you'd like. Also, during today's meeting, I'm sure there are going to be questions that you have and ideas that present themselves. So there's also an icon to the right with a little question mark, and when you hover over it, it says Q&A. We would urge you to just sort of drop in whatever thoughts or questions you have. They won't be shared with the whole group, so you can do it in a shorthand way. As long as Bob knows what you mean,
Yeah.
he'll be glad to respond either during our comments or at the end of the session. So before we dig in, I just wanted to say, Bob, Bob and I have known each other for since 2018
Yeah.
through the industry. At the time we met, Bob had formulated what has now become StepStone Private Wealth Solutions. I also have known Bob's co-founders for a longer period of time, frankly, than I've even known Bob. And the business, as I mentioned earlier, grown and is prospering. And some of the secrets of what they have in mind and how they're helping advisors will be things that we talk about today. So to kick off, Bob, do you mind just sharing kind of why you created StepStone Wealth and how you think about it today in the context of what's happening in our space?
Happy to do it. It's fun to revisit, the creation of this vision and where we've come from since. So when we met in your office now 8 years ago, we had a vision, and that was to create a next generation wealth platform for the private markets around two principles. The first was to make our offerings truly institutional caliber. And to be more specific, what we meant by that was the individual investors are getting invested in the same deals as the institutional investors at the same time, at the same price. And that's a big difference between what we've created and many of the first generation retail alternatives products that financial advisors may be familiar with. So same deal, same price, same time. The second was to aspire to be and to execute on being the most investor-centric firm in the market. And what we mean by that is to make our products the most efficient, which is a nice way of saying fee efficient or inexpensive, transparent, no surprises, and the last part, convenient. Because what we've learned, or what we knew actually when we launched the business, was that the logistical and mechanical operational barriers to doing the right thing for clients, putting a portion of their portfolio in private assets, that those operational issues were keeping financial advisors from doing the right thing for clients. And we were determined to bring down those barriers. Now, what I didn't anticipate when we met in your office as we were formulating this business plan was the amount of regulatory and technological development, frankly, advancement, that now has allowed us to offer a diversified portfolio of private equity, private credit, private infrastructure, and a model portfolio. All of those we're able to offer on a daily valued basis that financial advisors can purchase with a ticker without a sub doc like they would a mutual fund. So that's what's the same. The vision is the same. The operational use or ease of use has actually exceeded my expectations.
So is there anything else you'd like to share? Because you've said a lot, and it's super important. You were thinking about this really before the market has evolved as rapidly as it has in the last several years. You had a vision in mind. You just described kind of what you've accomplished. Are there anything that you've learned that's different than the original vision, or would you say it's how would you describe it compared to where you're thinking about that day when we were chatting in my office?
Well, there you were. You had the benefit of leadership positions with a number of major firms and a long career in the industry, which is a nice way of saying you and I are both a little bit old. Yeah, and I think I asked you because I was newer to this than my colleagues Neil Menard and Tom Sidema, who you knew well. I asked you if these products have historically been sold, not bought. And I asked you if there was a way to get to at least neutral, where the clients were in some cases asking for the product and were at a minimum open, as opposed to the clients products were being pushed. Get away from a product push. And frankly, I don't recall your answer, but we did ask a lot of other people as we went around getting advice to formulate our business plan, and that has changed. Today, in 2026, we hear from we do business with 500 platforms around the world, and about 400 of those are in the US. So I think we have a pretty good cross section. We hear consistently that clients are choosing their financial advisor in part, or one aspect of their decision matrix includes, does the financial advisor have fluency with private market products? Is the financial advisor, he or she, comfortable explaining and offering private market products? So, and we do see clients going or making a decision on that basis, and we see financial advisory firms, competing on the basis of what offerings they do provide. So I think that's a really big change.
Well, it sounds like an exceptional change. And maybe you'll expand on this. You alluded to it, but the market has changed in a lot of ways over these years. Are there any changes that are fundamentally different, kind of from an advisor's perspective? And if I can lead the witness just a little,
Sure.
When you and I chatted about this a couple of weeks ago, historically, going back, say, 10 plus years, financial advisors who use private market products seem to present them as a product, as opposed to the broader solution set.
Yes.
And can you talk a little bit about how that's changed and what's better now, and maybe if there's anything that's not quite as good, could you share, please?
I want to give you a thoughtful answer on that. Yeah, I think today, well, obviously, model portfolios is another huge trend in our industry, and you've probably done webinars on that, educational work on that. And so what we see today are clients or financial advisors, because those are our clients, are the financial advisors, as opposed to the end investor. What we see is those advisors implementing a framework around growth and income, the same things they've always done, but with a view toward getting some of that growth and some of that income from the private market. Because as opposed to, so here's an example maybe. Rather than thinking about, I've got X amount of alternative, I want 15% alternatives. I would submit that's not the way to think about it. It's rather to think the way that an advisor should think about it is, my client is at this age and stage, maybe they're in their deaccumulation phase. They want a lot of stability. And so how do I give them stability with some growth? Well, infrastructure, which, even at the time when you and I met 7 years ago, was not really well understood in the US. Private infrastructure investing, the ability for you and I to own part of the Charlotte airport, for example. And it's more well known, and we could talk more about that. So, look, product pushing is just a bad idea. Like, I'd rather mow my own lawn than be in that business. We're not in that business. We do offer a set of solutions. We attempt to help advisors incorporate that into a holistic solution. And I do think that's a sea change that's occurred.
Thank you for that. So as the CEO of a very successful business and talking to other executives, financial advisors, and individuals with the large wealth firms, when you and I chatted about this a couple of weeks ago, we said, well, alternative assets used to have a meaning. Private markets has a meaning. People seem to use them interchangeably, but they're not really the same.
They're not.
And so how should financial advisors kind of think about this whole space when they're when they are getting questions from their clients.
Okay. Let's define some terms to start. This is really important. All right. So alternatives would be anything that aren't stocks and bonds. Some people think about REITs as alternatives. Some people think about TIPS, inflation as and of course, hedge funds, commodities, etc. I suppose crypto, which I know nothing about, so I have no opinion on, could fit in alternatives. What we do at StepStone, and I should make sure I describe StepStone, we are a private markets firm. So we invest in private equity, venture capital, private credit, private real estate, and private infrastructure. We do all of those things. We do only those things. And we do that on a global basis. We operate from 27 offices in 16 countries. There are 1,200 of us. And we believe we are one of, if not the largest allocator to the private markets globally. We're responsible for $770 going on $800 billion of just private assets. And we allocate, meaning we invest on behalf of clients, 70 billion or more per year. So not much happens in the institutional private markets globally that we don't see. So we're a private markets firm. Let's go from there back to your question. And now that we've defined the terms, how can I be more specific?
Well, one question I would have is, clients are beginning to ask advisors questions that they perhaps didn't ask a few years ago. So in some of them you just covered. Well, what I'm seeing on television, some of these high net worth firms talking about investing in some of the asset classes you described. And can you help? I mean, if I were an advisor and one of my top clients came in and asked that question, I want to be able to answer it in a way that's useful and doesn't sound like I'm just kind of, if I'm not using a lot of private market products and solutions, I might kind of dodge that question. So can you help me? How would you recommend I respond? And a little further, how would you recommend I think about the space? Do I start with one type of product, or do I try to allocate into all the various products? Or, I mean, you work with institutional investors. How should retail investors think about this stuff?
All right. Here's how I would start. There are several questions in what you asked. Here's how I would start as a financial advisor. I would acknowledge that, first and foremost, the public markets do not offer the level of diversification opportunity that they did 20 or 30 years ago. They simply do not. Companies are going public much, much later. On average, they stay in the private stage twice as long today as they did even 10 years ago. They're about half the number of public companies, just the things to choose from in the public markets than there used to be even 15 years ago. And moreover, here's a stat that I would suggest everyone really bear in mind. Today in the United States, 87% of companies of size and scale, 100 million of revenue or more. This is not my personal LLC or the corner restaurant. We're talking about investable companies. 87% are private, and that trend is only going in one direction. Similarly, SpaceX has, so this is well publicized, so I'll use this example. Now, SpaceX just announced a valuation of about $800 billion, right? And they have indicated they plan to go public. You know, the press has speculated, no opinion here, not recommending that they will go public at twice that value. So you think about that. That's from $0 to $1 trillion or more of value, if that happens. And there will be some IPOs in the next year of companies valued at $1 trillion. I'm fairly confident of that. Some of the AI firms, et cetera. All that value from 0 to, say, $1 trillion was captured by private market investors. Whereas when the tech titans we know, the eBay, the Amazon, the Googles, et cetera, when they went public, they went at a much earlier phase and a much lower valuation. So the public market investors, you know, if they were wise and or invested in those companies that IPO or shortly thereafter, they benefited from substantial appreciation. But today, if you don't play in the private markets at all, if you exclude that opportunity set, You just don't have any access to it. Moreover, this financial advisor group on the phone, I'm sure knows this better than I do. Public stocks today are driven by memes, media, and momentum. Right? It's unfortunate. It's not a good thing for our country. One would have thought that markets would have gotten more efficient and driven out some of that, but that's not what we've seen happen. And finally, the headline, the public markets tend to be driven by companies in a few sectors, particularly technology. So just the ability to create, I'll make a strong statement, and I'm prepared to stand behind it. Your ability as a financial advisor to create a properly diversified portfolio for your clients, if you only are choosing from publicly available stocks and bonds, it's very difficult. I think it's very difficult to achieve that for most sophisticated clients if you're only choosing among those. That leads you to the private markets. Now, what's the big change in the private markets is we've developed evergreen funds for individual investors that have low minimums, that can be bought on a ticker in many cases, so no paperwork. In many cases don't require any accreditation, daily valuation, SEC registered, 1099 tax reporting. So it's gotten much easier, still not perfect. It's not quite like buying a mutual fund, but it's gotten much easier, particularly in the RIA channel. The wirehouses tend to have some restrictions that they impose internally on these trade execution processes, but particularly for the RIA and independents, to actually achieve exposure to the private market. So the net of that is it's become an essential part or fundamental part of portfolio construction for so many financial advisors today. That's a big change.
That is super important and super insightful. Thank you for that. And just an observation, it seems if clients are asking financial advisors on this call who are independent in most cases, we need to have a fulsome answer to that question, because if we don't give it to them, perhaps someone else will. So let's take a quick poll question, if you don't mind.
Sure.
As I mentioned earlier, to the right, you can tap on that icon and respond. And I hope it opens up soon, because I'm waiting for it on my screen, but I can tell you what the question is. Which private market asset classes are you currently contemplating using for your clients in 2026? I don't know if we have a technology challenge here or not.
Yeah, I'm not seeing it yet either, but maybe it's not popping up for the host.
Well, let me tell you what the options are, and if we don't get it up fixed quickly, then we'll at least be able to speak to this. And most folks are looking at a few asset classes, and you mentioned a few of them: private equity, venture capital, and growth equity, infrastructure, Bob, as you had mentioned, real estate, and private credit. So forgive me for the technological glitch we have here, but maybe you can just speak to what you're seeing most advisors starting with.
So I like to do this poll actually on every webinar that we do, and then we sort of compare over time. So particularly for independent advisors, we see a lot of interest in private credit and infrastructure. Many people are familiar with private equity and have some private equity allocations, but infrastructure is something that's new to the U.S. High net worth channel. If we were in Europe or Australia, you'd be accustomed to the idea. I think many of us don't appreciate that an individual investor can invest in a diversified portfolio of assets like toll roads and bridges and battery storage facilities, data centers, etc. And so it's the most diversifying thing you can do from an institutional asset class. Again, I'm excluding crypto. To diversify client portfolios. So we're seeing a lot of interest there. Now, there needs to be education there. We've done a lot on that. By the way, you can find a lot on our website, stepstonepw.com, where you can go to my LinkedIn and you'll see a lot of information. But that's where I'd say the peak of interest is right now.
That's super helpful. And then I'll admit to everyone on this call that user error on my part. The poll was live. I needed to click on that little icon that I asked you to click on, and as you look at it, I'm just interesting. It's about a third of the folks on the call are saying they're focused on PE, a little more than a third on venture capital, and then followed by infrastructure and private credit. Notably, no one said none, and no one focused on real estate. So just a couple people at the end. So very interesting. Thank you. And so I wanted to ask you, as you look at 26 and beyond, and you're thinking about products that are not yet out there, either with StepStone or other firms that you see coming and being important here in the next, say, few quarters, what comes to mind, Bob?
The big trend in our market is model portfolios. So we had financial advisors get familiar with, and in many cases, because they felt like they had to, because they were losing clients, get familiar with private markets. They invested the time. Then they're coming to us and others and asking, all right, how do I implement? And so there are a number of model portfolios have been created with the TAMPs. We have assets in some of those. We're working to have our assets in other of those. But then we have our fund called S Prime, which is a model portfolio that has primarily private equity, but a meaningful allocation to infrastructure and private credit, and is sort of the single ticket core solution. It's a big fund, $5 billion with a 5-year track record. And so model portfolios, implementation of S Prime and its peer funds from our competitors, that's a big trend. Private credit obviously has garnered a lot of attention. Advisors typically use private credit first. That'll be their first foray into private assets for their clients. So, and that's primarily direct lending, a directly negotiated loan, typically to a private equity sponsor, not through a bank, bespoke terms, usually a bit of a higher return, covenants, that sort of thing. So that market, there are a fair number of products in that market today. We've brought a fund that now has specialty credit. It's called CredX. And the big picture for private credit, and we've all read about the massive growth in private credit, was the banks pulled back from merger and acquisition lending, and private funds, private pools of capital fill that space. Well, the next frontier in the disintermediation of banks, we believe, is this specialty finance market, the asset-based finance, for example, receivables, leasing assets, et cetera. And so we've introduced a fund, as have others, that have aspects of that. So I think specialty credit will be the new direct lending. So I think that's the trend. That's the theme and headline you'll see for next year.
Fantastic. So just to reflect on your last 2 or 3 years, let's say last year in particular, your business is almost tripled in size. Yeah. And a lot of the financial advisors who you're working with haven't historically invested outside of the traditional stock, bonds, cash that we talked about earlier. Can you just kind of help us understand two things? One is, how are you helping what I'll refer to as experienced, great advisors find their way appropriately into your area? And why has the firm grown so fast in a 12-month period? It's quite remarkable.
Thank you. We've grown from about 15 billion of assets to about 20 billion of assets over the last, from 6 to 15 over the last year. It starts, and the answer to both your questions are similar, actually. So it starts with education. We believe that leading with education is a great long-term investment for us to make in you, the financial advisor, because we understand our real job is not to push product. It is to help you serve your client. We believe that you better serve your client if you at least consider private markets as an aspect or component of the client's portfolio. So we do something called StepStone Academy, for example. You can find this at stepstonepw.com. Again, we're very active on LinkedIn. It's very inexpensive and very effective advertising. So StepStone Private Wealth Solutions, you can follow us there and find much of our information there. But it starts with educating clients. So if you work with us, we can provide you with that client conversation outline that really helps an advisor kick off the conversation. We've also built a very large sales force, about 40 dedicated, experienced professionals in the United States alone that work with financial advisors and are ready to get on the phone with you and your client. And what we often see is the financial advisor new to us or new to the private markets wants a sidekick, a ride along for that first couple of calls, and we're happy to do it. So we get on the phone with the advisors, help them tell the story, and then they're able to pick it up from there. In addition to that, look, it really comes back to our mindset. And we know our job is to help you serve your client. And the thing that I think we've done best and compared to our peers is make our products easy to use, right? Making them buy on ticker, daily valuation, low minimums, very transparent, very simple disclosures. We think we lead the market, that's subjective, and how transparent we are about how we reach our returns. Do that in a quarterly fund commentary. So all of that has really helped us grow.
Very, very interesting. So you're covering a lot of macro and even getting down to some of the specific trends that we're seeing. But do you think the overall trend here toward these types of products and for high net worth and even perhaps even some of the less than ultra high net worth clients is something that would you consider this to be a cyclical moment or a structural moment? And should advisors care? Should clients care? How should they position?
I truly believe it is structural. I don't think Sarbanes-Oxley is going to be repealed anytime soon. I have been the CEO of a publicly traded company twice in my career. It's for the birds, by the way, and there's a lot of needless complexity and a lot of inefficiency built into that. And so, while the Trump administration is doing a lot to reduce regulatory burdens throughout the economy, I don't see Sarbanes-Oxley changing, and I don't see companies wanting and needing to go public. In part, this is something we haven't really covered. That's a sea change during our working careers. When I got out of school I'm 64, so in the 80s, right? If you wanted to build, first of all, the prestige, you wanted to be a public company officer, and had the privilege of doing that twice, and today's generation doesn't care about that. I can assure you, number one, but probably more importantly, if you wanted to build a business of size and scale, something that needed a lot of capital, you had to go to the public markets. If you were going to get a 2 or 3% allocation from all the big pools of private capital in the world, you wouldn't have been able to build companies on the scale of a SpaceX, for example. You just couldn't have. And that company, while it has announced plans to go public, they've raised over $10 billion in private rounds of capital, and clearly could continue to do so and have continued to do so. So you just couldn't have done that. And what could be more capital intensive than building rocket ships? Really hard to think of much. So the fact that there are deep, broad, sophisticated private markets that can finance a business beyond the startup phase, that's a big change. The regulatory burden not changing, those are structural. And then, as I mentioned earlier, the emergence of evergreen funds that make it easier for private capital to be raised from individual investors in a convenient format. The combination of those factors, I very much believe this is a structural change. I don't think we're suddenly going to see a plethora of private companies. We're not going to see the Russell 2000 suddenly repopulated by a lot of high growth companies that you want to invest in. I just don't see it.
You don't see it. Interesting. So I'm labeling this a tipping point. I don't know if you've used that word exactly, but I have heard you say that we're kind of beyond the democratization of these types of investments now. Why do you think that? Because when I read the statistics, still it's a significant minority that there's a minority of, you know the percentages better than me, but most advisors are not currently using these products. It seems almost like a pull strategy where investors are asking before the advisors are offering. And what's going on here?
Yeah, I have been quoted. It's a little bit of controversial, but that I do that intentionally. I think we're beyond democratization. I think there's been access, if you wanted it, for a long time for individual investors into quality private market products. What's different today is I believe we're in the institutional phase of that democratization. And I break that down into a couple of metrics. First of all, fees are dramatically lower. Today, in the bad old days, and let's acknowledge there were bad old days, there were products that had very high fees, very high upfront loads that were not particularly transparent. Well, I'll make sure I cover this. The early products and what's changed are today, the fees that we charge and those of our high quality peers are right on top of what an institution would pay. I'm not saying they're the same. Clearly, individual investors will often pay a little bit more because they're putting in much smaller tickets. But the premium, the difference between what institutions pay and individuals is very modest, and I'm happy to defend it. It's very reasonable. Second, most important, same deal, same price, same time. That's just critical. The products that we offer and our high quality peers offer today are giving individual investors not access to the special deals that the institutions didn't want. They're investing in the very same deals as the institutional investors today. And then finally, transparency. This is a finer point, but the modern products, ours, and I think we are particularly distinguished in this, you understand what you're investing in, what you're being charged, how it's performing in a very clear way that the average person can understand. And those three things I refer to as the institutionalization of access rather than the democratization.
Well, this seems like I had put together a poll question. I think I'd like to throw it in right now. So if you don't mind clicking over there, folks. So the question is, and you kind of alluded to this, Bob, what do you see as the biggest risks associated with allocating to private markets today? If you're an FA, maybe you were in this business back as you referenced the bad old days, and now you're saying the time is right. How should I be thinking about risk?
Sure. All right. So I'm watching the poll question too. Figured out how to do that. Look, there are a variety of risks. Clearly, a variety of risks. The one I hear the most is illiquidity. Clients need to communicate very clearly, or advisors need to communicate very clearly to their clients that we are not magicians, the product providers, right? We can't magically, well, let's be clear, we haven't talked about this, but I want to state it. The reason you invest in the private market product is for the return premium potential, the opportunity, which historically has been there, to receive a premium return over the public markets, and also some volatility dampening, which we believe reduces risk because of lack of correlation with the public markets. So that's why you're doing this. You're taking on illiquidity in order to gain that return premium potential and that diversification or risk mitigation benefit. But that means by definition, the products are not perfectly liquid. And therefore, we as the product provider and the financial advisor need to communicate very clearly to their clients what the liquidity is and what it's not for these funds. And so, for example, what we often see with financial advisors just getting into the private markets, first thing they'll do is they'll write a ticket for themselves and they'll do it in their IRA. I may not have mentioned this. All these evergreen funds, they're 40 Act registered, like a mutual fund. You can buy them in your IRA. All right. So you sell something in your IRA, you incur no tax, you trust run it yourself, and you see what it's like. And then you go to your clients who have pools of capital. Think about the individual investor. They aren't planning to touch their IRA in many cases for quite some time. In fact, they may see it as something they actually will leave to their children. And you start there, so you put it in there. So the key risk is understanding the liquidity. Most of these funds provide quarterly liquidity for typically 5% of the fund. And this is an important distinction. It's 5% of the fund, not of your investment. They get their money out with no transaction costs. It's not like selling a private asset in the secondary market where they're legal fees and discounts and all that stuff. And that's your liquidity mechanism. Now, we always tell clients, do not invest in our funds with money that you might need on 3 months or 6 months notice. Don't do it. We don't want it. Right? These are still longer term investments. Liquidity is there for your convenience, and you need to plan on the possibility that in a capital markets meltdown, that more than 5% of the investors want all their money out in a given quarter, and your redemption request may be prorated. And if you and your clients aren't comfortable with that, let me explain prorated, by the way. Yeah. People use this word gate. I hate the word gate. In fact, I think it's misused. A gate is when a hedge fund tells you that you have full liquidity, and then they don't want to give you your money, and they point to a footnote in their prospectus that says they can side pocket certain investments. That's not what we do in evergreen funds. What we do, we and others, if for whatever reason we're offering 5% liquidity per quarter in structure, our infrastructure fund, and 10% of investors want all their money back, what we would do is we would give everyone half of their money, again, on a very short notice period at the quarterly redemption period, no transaction fee, no discount, and they'd be free to come back and put in a redemption the next quarter. So that's the way it works. We believe, and the proposition we are selling is that you, the client, will benefit from the illiquidity premium and that risk dampening by owning private assets, and that you have the convenience of this liquidity mechanism that will be there most of the time if there's not a storm in the capital markets. But even if there is, you need to plan on it taking several quarters to get your money out. And so size accordingly. And again, if you're not comfortable with that, we're not for you. We're just not for you. But if you do, in our view, the vast majority of clients, certainly clients of several $1 million in net worth, can afford some sort of illiquidity budget, some sort of pool of capital for which they don't need access immediately, and for which they should, in our opinion, benefit from an illiquidity premium. By the way, I'm just seeing the results here now, so give me a second. I'm curious. My clients will not accept any illiquidity. Okay, well, that's 70% of the results. I don't know really how I answer that. I would just say that if clients really, maybe I'll use this analogy. My mother was a realtor for most of my life. And, she advised people on what kind of mortgage they should get when they were buying a home in our hometown. And so most clients, well, I would say it's a mistake to recommend a 30-year mortgage for a young client who's buying a starter home and fully plans to have a couple of children and move in a handful of years, right? And so I just think this is a similar analogy. I would assert that most clients actually can afford some sort of illiquidity budget, and maybe quite small. But the great thing about the evergreen funds that we offer and others offer, minimums start at $5,000. So perhaps that's a misunderstanding with those who answered the poll. You can put just their IRAs in. You can take 5% of their portfolio and do it. And so that's our view.
So can I ask a quick follow-up on that? So as you're thinking about a client with just say a net worth, to just use a somewhat arbitrary number of $3 or $4 or $5 million, and they have assets in a taxable account and in an RIA, and they probably have a Roth. How do you think about allocating between different types of funds? Because certainly some of those are not intended to be, they may be liquid, but they certainly don't expect to use them for a long time.
Right. Here's how I think about it. I'd start with that illiquidity budget, and I'd look first, depending on the age of the client, at that retirement pool of assets. I personally, and my partners here at StepStone Private Wealth, have put a substantial part of my IRA, and I am 64, but I will be in a position to pass on that IRA to my children. A substantial part of my IRA in private assets, because that's a pool of capital that I do expect to compound for a substantial period of time. So first set the illiquidity budget, look at those retirement accounts first, and then think about what you're trying to achieve. What's your mix of growth versus income, for example? So in the growth category, my opinion, it's quite hard to find high quality growth public stocks outside of a handful of names. You look at the Russell 2000, half those companies aren't profitable. I mean, it's a little controversial, but some have said the Russell 2000 is the companies private equity doesn't want to buy. And I think there's some truth in that. So to find high quality, high growth stocks outside of those large tech names is hard to do. We offer a fund called Spring that is late stage venture capital and growth equity. These are not garage startups. These are companies with 50 million or more of revenue on the median or the median company. It's companies like SpaceX, like Anduril, like XAI, but also non-tech companies like Viore, which is growing really quickly, and they're in your backyard, Larry. I think you're in LA.
Yep.
Or here's a good one, Farmer's Dog. You wouldn't believe how loyal people are to paying a ton for dog food. Actually, you probably would. And so that's a great business, and we're proud to own part of that. So growth, we look at something like Spring. Credit. So private credit has gotten a lot of attention. We do think for most clients who want access to steady income and low volatility that private credit makes sense. And so now that income is that's regular income. So depending on how you think about your asset allocation, that may belong in your taxable account or your non-taxable account. A fund like Spring, most of those gains are long-term capital gains, or at least they've historically been, and the fund is not designed to do that on a go-forward basis. So that's two extremes. We could go in between if you'd like to go into more detail or your next topic.
Oh, that's great. So just I have one or two more questions and a poll, and I'd like to leave some room for Q&A at the end because we have some questions coming in. But for advisors that are view themselves as allocators, are you seeing any trends that are either positive or negative? Because allocating in private funds is different than allocating across liquid funds. So what are you seeing that is working and perhaps not working?
I'll tell you what doesn't work. That's the easy thing. The number of times I meet with a financial advisor, they ask really smart, detailed questions, have 2 or 3 meetings, and then they reward us and they tell us, I'm going to allocate to your fund. I'm going to put my top 3 clients in it. And I think, thank you. We appreciate the confidence in us, but gee, that was a bad use of your time. What I see is advisors dabbling. I would suggest your time is your most valuable asset, whether that's gaining new clients or taking care of the ones you have. That's why we were so focused on creating these products without paperwork. We understand that. I would submit to you that don't dabble. If you're going to take the time as a financial advisor to do the due diligence and fully understand a private market product, you should be asking yourself not which clients do I have to put in private markets because they're going to leave me if I don't, or I don't at least show it to them. You should be asking which clients don't deserve the opportunity for return premium and risk reduction of the private assets. So that's number one. Second thing I see is, again, model portfolios. So we see a lot of advisors simply choosing S Prime, our core fund, and its competitors, our core model portfolio, and just putting clients into that because it's easy and it's low fee. Those are 2 big trends that I see. And then obviously everything in between.
Fantastic. Well, let's do, we have one more poll. Let me ask the team to put that up. But the question is, and you talked a little bit about this, but for financial advisors considering or already involved in allocating to private markets, what kind of concerns do you have? So you may be a believer and you may be a recommender of these products, but you still, like all of us who care about your clients, go to bed at night and some things might be concerning you. What are those things? And as they're being put up there, the answers might be lack of liquidity, which we've talked a lot about, the administrative inconvenience. And of course, a lot of that's changed, but not that long ago, this was a really labor intensive kind of trade and then ongoing reporting. And then not being able to explain well to your clients or perhaps not understanding it well enough. So when you do explain it, they're not sure. Let's give you a second to respond, and then Bob, whatever, if you don't mind, just any
Sure.
observations you have.
Yeah. I think we've talked a lot about lack of liquidity,
We
the
have, yeah.
administrative inconvenience. It probably will come based on the responses we've gotten. It may be news to a number of the advisors on the phone that they can buy these funds with low minimums, 1099 tax reporting, and with no paperwork on all of the custodial platforms. In most cases, we have a solution that is no paperwork, and so I think the administrative convenience is something we largely take off the table once people understand it. And they cannot explain. I have tremendous empathy for that. I totally get it. And as I mentioned earlier, we have done a tremendous amount to educate advisors. We want to meet you where you are. There are no dumb questions. And so helping you understand, answering your questions, making you comfortable with it, that's really core to our job. It's really core to our job because, again, our job is to help you serve your clients better. We happen to do that by providing private market products, but the business we're in is helping you serve your clients better. And we really try to keep that in the forefront of our mind with everything that we do.
All right, great. So this is a closing question, and we're asking it at this point because I think you've covered some of these topics. But if an advisor is now deciding or has decided to include private markets kind of in their overall asset allocation,
yeah,
and given the way the traditional asset allocation, you might rebalance every quarter or some frequency throughout the year. When you're investing in private markets products, how do you think about kind of your investment portfolio design over time? Is it different? It seems like it should be.
You cannot rebalance immediately. The lack of liquidity, again, was a concern there, and I do want to come back to that before we close. So you do need to think about these as longer-term holds. So you need to build core positions. Now, the great thing about these is, the evergreen funds in specific, you can trim or add, right? So the add-ons are typically $5,000 in size also. So you can tailor your allocations to the private markets through the evergreen funds much more easily. But you do need to bear in mind that your commitment, you need to be committed to these assets on a little longer term format. So back to this lack of liquidity, I'm just going to try to be a mind reader here. And I suspect that a number of people are unduly influenced by the headlines around a couple of large real estate funds who, in some cases, have not been able to provide the liquidity that their clients expected. And I want to address those head on. First and foremost, those real estate funds, I won't name them, but I think we all know who they are. They're investing in very similar assets to those you can own in the public markets. And so their clients and financial advisors were making an arbitrage decision. Gee, apartments are valued one way in the public markets and one way by this leading sponsor. I'm going to sell one and buy the other. I understand that. Well, in the case of the funds that we offer, you really can't do that. Right? There's not a replica, a public market substitute for Spring, our venture capital and growth equity fund, for example, nor for our model portfolio. So there's a fundamental difference. And real estate sort of stands alone in the fact that there are public market substitutes that people can toggle between, and it sort of created an unfortunate trading opportunity. Second, in the case of our funds, we've never had to prorate. We've never been close to having to prorate, which again, as I mentioned, in the case of all hell breaks loose in the public markets, that could happen over the next 20 years. That absolutely could happen, but we've not had to do that, nor have our high quality peers had to do that, because another big difference between today's private market funds and those of 10 years ago offered to individual investors is we have focused on not only of a diversity of investments, but diversity of investors. You don't want us to be, we don't want to be concentrated with all our money coming from one or two wirehouses, where if the home office changes their mind on us, suddenly we have a lot of redemptions. We don't want that. You don't want that. They don't want that. The lessons have been learned in the market. And so today we have built a very diversified range of investors in our funds, which also limit the redemption, the possibility of redemptions stacking up in the event of a mild storm in the markets. But of course, as I said before, in the event of a real market meltdown, you will see that. Now, that said, it's important to point out, I've been in the private market investor for a while, and the data will totally back this up. Difficult periods in the capital markets, periods of market dislocation, have historically been the very best time to invest in private assets. Private market fund investors are good at providing liquidity when liquidity is in short supply and getting paid for it. And so maintaining allocations across cycles is what institutions do. When you read all these statistics about how institutions have benefited from being invested in the private markets, it's not because they were invested in the private markets in years when the S&P is up 17 to 20%. It's because they were also invested in private markets when the S&P was down 10%. And the compounding effect of that over time is what's allowed them to dramatically outperform over periods of time. So you need to be invested and you need to stay invested.
Well, if you don't mind, I'd have a couple of questions that came in from the audience.
Right.
One of them is, I think you're quite ready to answer, and that is that if advisors have decided they want to begin using evergreen private funds for all the reasons we're talking about, and there seem to be more opportunities coming to market through your firm and potentially competitors, what do you have any pro tips that how should they think about this so that not every day isn't a new day when a new fund is introduced?
Yeah, good question. So you should obviously diligence these funds, or your firm's home office should, the way they do others. But here would be my 2 pro tips. 1, fees matter. Make sure you understand the fees and you're taking that into account. And second, allocation policy. If there's one question that's typically not asked that should be asked, it is, tell me how the institutional clients are getting access to deal flow, or I mean, said differently, tell me why my individual investor clients are not being adversely selected. Tell me how, when there's more demand from the various clients of the firm for a particular investment, how it gets allocated fairly to the evergreen retail fund versus the institutional clients. And the answer you want to hear is same deal, same price, same time. If you hear anything else, be wary. That's my number 1 pro tip.
Well, hugely helpful. So there are a couple of questions that came in just around, and one more on evergreen funds. I think we covered this, but why are they the most or more convenient place to start for financial advisors? Yeah, and if you don't agree that they are, what would you recommend?
Well, they are. To fully answer that question, I need to explain the alternative, which is the traditional drawdown fund. These are the limited partnerships where you make a commitment to a fund, and then it's drawn over time in an unpredictable fashion, and the capital comes back to you unpredictably. And so that works great for large institutions. It doesn't work very well for individual investors. And then, of course, the evergreen funds are 1099 as opposed to a partnership tax return, a K1. By the way, you get the 1099 by the first week of February, so you're not having to delay your taxes and those other features.
Fantastic. Well, the only other question that came up, and I'm very curious about this myself. You talked very early on about private credit, and I think most financial advisors, when they read about private credit, it makes so much sense to them for all the reasons that we've talked about, and I'm sure others have read about. What is the market kind of missing about private credit? I mean, is there anything? Is it as it appears to be, or is it? Because if you really dig into this, I guess another way to say it is, how does it fit into diversification? And if we have any positive or negative surprises, what might they be down the road?
All right. What the market may not appreciate is these are floating rate loans. Okay. So it is true when the risk-free rate goes down, your nominal return goes down. So that's something people don't appreciate. Certainly, I realize that's a little nuanced to explain to your clients, but look, none of us are immune from macro market conditions. We've all been through this zero rate environment, which was very interesting to say the least, and produced some market distortions. And I'm not saying we're going back to that, but the market isn't appreciating that a declining rate or risk-free rate environment over 2026 might actually make private credit more attractive on a relative basis compared to other assets.
Very interesting. Well, Bob, this has been an absolute pleasure, and
You too.
I have to say I learned a lot. I spent a lot of time reading about private markets in your firm also, but this has been great. Thank you. Any closing remarks you'd have for our listeners?
First of all, we'd love to help you, obviously. StepStonePW.com, our LinkedIn. We have a team that covers the United States with 13 territories. There are phone numbers and emails you can reach out to. And let us know how we can help you. We'd love to be helpful from an educational perspective. We're working with a number of your firms already. We'd like to work with the others. But StepStonePW.com or our LinkedIn are great ways to reach us.
Thank you, Bob. And we will at WSR, we're going to publish a follow-up article on this, and we'll make sure that people know how to reach you and your team. And Happy New Year. This is a great way to kick it off, and I'm grateful to be a part of it. Thanks so much.
Thank you. Bye-bye.
Bye-bye.